I have a soft spot for all the self-employed people out there because I'm one myself. And that gives me a real appreciation for that hunt to survive mindset you have to have when you're running a business. And so today I thought I would do a video talking about superannuation specific to the self-employed community. So this video is not only going to talk about the mandated obligations of paying yourself super, if any apply to you, it's more going to focus on the benefits of superannuation from a tax minimization perspective and a way to help build up an asset base separate to your business. Unfortunately, I do see a lot of self-employed people putting all of their time, effort, attention, and money into their business and ignoring the personal side of their financial equation. And obviously this is to their own detriment because not only are you going to miss out on opportunities to save tax and build some wealth, but also you need to diversify away from your business a little bit to de-risk your situation. Hello guys, Brad here from The Guided Investor. Welcome back to the channel for another video. If you're new here, consider hitting the subscribe button because I post regular videos about how you can do more with your money. And today we're going to be talking about superannuation for self-employed people. Firstly, do you need to contribute to superannuation as a self-employed person? Well, that's going to depend on the business structure that you have set up. If you treat yourself as an employee of your own business, then yes, you do need to make the 10% superannuation guaranteed mandated contributions. So this is really going to apply to a lot of people who operate through a company and maybe a trust, as it's fairly common practice to pay yourself a wage or salary. There's no obligation to pay SGC on any profit distributions, loans, or drawings. Also, if you operate your business as a sole trader or a partnership type structure, then there's no obligation to pay SGC there either because you can't actually treat yourself as an employee. So now that we've covered off the mandated requirements to pay yourself super, let's consider if voluntary contributions are actually a good idea for self-employed people. And the answer is yes, in most instances. As a business owner, you need to be considering how you structure your assets and your income from a tax perspective. And this is where superannuation can play a really key role because it's a very good tax structure. Any income or capital gain you generate inside your super will be taxed at a maximum rate of 15%. Now, this is a lot lower than the company's tax rate, which can be 25% or 30% depending on your turnover, and most people's marginal tax rates, which can get up to as high as 45% plus Medicare levy. And what is even better is that when you reach age 60 and you retire from the workforce, you can transfer your superannuation to an account-based pension, which is a 0% tax entity. So that is no tax on any income, no tax on any capital gains, no tax on any withdrawals, and franking credits get rebated back into your account. And what is even better than that is that superannuation is the only structure that gives you a tax deduction for investing for yourself. So you put money aside for yourself, invest it, and the government say, no worries, good work, we're gonna give you a tax deduction. That is pretty damn cool. So the tax benefits of using superannuation are pretty compelling, but there are restrictions that you need to follow and rules that you need to follow before you start using your super. Firstly, to be eligible to contribute to super, you need to be under the age of 67. If you're aged between 67 and 75, you need to meet a work test in order to contribute. Once you've reached age 75, you can no longer contribute. You can only contribute up to your annual cap limits each year. If you want to claim a tax deduction for your contribution, you'll be using the concessional contribution cap limit, which in the 2021-22 financial year has a limit of $27,500. There is a carry forward allowance for unused concessional contributions from previous financial years. So if you didn't maximize your cap limit in any year from the 2018-19 financial year onwards, then you can carry forward that unused amount for up to 5 years. In order to access this, your super balance does need to be less than $500,000. And any concessional contribution that is made to your superannuation is going to get taxed by your fund at the superannuation rate of 15%. Now, if you earn over $250,000, well then first of all, good on you. But secondly, you may also incur Division 293 tax, which is an additional 15% on contributions. Also, just remember that in order to access your superannuation, you need to meet a condition of release. Now, for most of us, this condition is going to be have met preservation age and retired from the workforce. There are limited circumstances where you might be able to get your superannuation earlier than that, but I won't go into those now. So the idea of using superannuation as a self-employed person is it's a way to build up an asset base separate to your business, invested for the long term in a very tax-effective environment. And as a little bonus along the way, you're gonna get a tax deduction, a personal tax deduction for investing that money. So if you aren't using your superannuation properly, then there's probably a very good chance that you're not maximizing your financial position. But that's it for me today, guys. Thanks a lot for watching. I hope you liked this one. If you did, please give it a thumbs up and I will see you guys in the next one.